And they've taken their homeowner's policy, which is again your personal liability. They've got a couple of dwelling fire policies out there, and they take that personal liability and they extend it to cover those homes, those other rental properties. My challenge with that, not only as an insurance agent, but as an investor, is you just undid some of that work you tried to accomplish. You tried to build those castle walls, and you just gave somebody a great big gaping hole right into your castle. I don't like that from an investor's perspective, let alone an agent's perspective. Anybody out here require tenants to carry renter's insurance? Remember when water beds were the end thing? Everybody's like, you better have that water bed insurance. What you're talking about is renter's insurance. You have a liability protection to get damage if the water bed got the big hole in it, get all the water damage to that unit. It's not a bad idea, even if you do not require your tenants to carry the liability insurance, to ask. All the agent or all the tenants can say is no, is if they do carry it, to name you or your entity as an additional insured for the liability side. Just get your name on a policy and create a little bit of a buffer, maybe a little bit larger moat on the outside of that castle. Again, I'm not an attorney, but anything you can do to build another wall or another layer of liability protection in there in case they have that dog that sneaks out the back door and bites a neighbor's kid. Go to their renter's policy. Let them go to their renter's policy first for that protection and not to your landlord type policy. Deductible. Higher deductible, the lower the premium.
Yes.
That's simple. Anybody in here self-insured? Everybody does. Carry deductible. That's self-insurance right there. You're eating that first part of that property claim in the form of a deductible. I've always had the attitude, my rule of thumb has always been take the smallest claim you'd ever file. Not on the liability side, I want to touch on that in a second. Take the smallest claim you'd ever file and double it. And that's where at start what you carry the deductible. There's a point of diminishing return. There's a 2007 vehicle sitting out in the parking lot worth $25,000 on a bought vehicle. To go from a $500 to a $1,000 deductible on the collision saved me about $12 every 6 months. Yeah, 12 bucks. Now granted, knock wood, I haven't had that out-fault accident, so I would have saved a lot of 12 bucks over the last 10 years. But still, what I'm driving at is, you've got one property, and the premium savings to go from $1,000 to $2,500 deductible, let's just say to make the math easy, is 10%. Well, if that 10% is on a $700 annual premium, that's 70 bucks a year is to basically go from $1,000 to $2,500 deductible. If you got 15 properties, it may still be 10%. Then you start talking about some value in going to those higher deductibles. You start to work with statistics and how many claims you're really going to have in the course of the year, that kind of stuff. Again, we're not going to pay retail for repair work either. So if you're asked to file an $800 claim, think twice about it. Whether it be the effects on your insurance, whether it be whether you're really going to need to do $800 claims even really occur these days. Again, what is catastrophic to one is not catastrophic to another. I've had clients say to me, $10,000, no problem. That's a deductible. And then if you're just getting started in business part-time with $10,000, they put you out of business. So each his own, he said.